Hello and welcome to this channel. Today, we are going to discuss about market structure. And under market structure, we are going to discuss two things. We are going to discuss, that is, the break of structures, we are also going to discuss the change of character. So, under this, I'm just going to use simple skeletons to illustrate what really happens in the market. For example, on an uptrend, you usually see the market move from the swing highs to the swing lows. So this is basically what we see happening in the market, whereby the market is moving from, we have the swing highs and the swing lows. But when we are referring to an uptrend, we call them the higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. So usually the market breaks the structure to the upside. So that is where we have our break of structure at that point. Then the market continues to break structure to the upside. But now, the most confusing thing when it comes to market structure, there are certain things that people don't really understand. Now, in this video, we are going to discuss 4 rules that someone should follow when marking the break of structure. So we are going to discuss considerations when marking valid break of structure. That is what we are going to be discussing today. The first, I'm just going to outline them first. So one thing we want to see imbalance in the market. So on an uptrend, this is the push upwards from where we had the break of structure. Before the next pullback. Now, let me explain that. One thing that you need to know, who are dominant in the market? That is the question that you should ask yourself. So when we refer to as imbalance, I'm talking of in an uptrend, you want to see that buyers are dominant in the market. While on a downtrend market, we want to see that sellers are dominant in the market. Remember, break of structures, they signify continuation in the market trend. So on a downtrend, this is the push downwards before the next pullback. So that is what we're going to be discussing in this video. So that is criteria number 1. we are going to highlight each and discuss it in details. Then number 2, on an uptrend, the low, the previous low should not be taken out stroke broken. While on an uptrend, on a downtrend, the previous high should not be broken. Then, number 3, we are going to discuss. Here we look at the highest point and the lowest point. Now, if you understand number 3, then you are going to understand the reason why we call them higher highs, higher lows, or lower highs, lower lows. Okay? So, let's go to each and discuss. Then we are going to discuss number 4. But number 4, we are going to be looking at the Fibonacci retracement tool. So let's discuss each into details. So that is, so we have our number 1. Now I say that the first one, when you have a break of structure, we want to see that push before the next pullback. So this is where we have the break of structure at that point. We have the break of structure at that point. So after this break of structure here, we want to see that buyers were dominant in the market and continue to push the market further upwards then before the next pullback or retracement. Reason being, if the market just wicks above that point, then it means this can be a reversal in the market, and the market can reverse on the direction. But if the market gives us that push upwards, then we have a pullback. Then we know that buyers are willing to continue pushing the market higher and give us the next break of structure. So that is what we refer to as imbalance in the market. And that is the first rule that you should be checking when marking varied break of structures. So you need to see this. You need to see this imbalance in the market. So that is what I'm referring to. Then the second criteria, on the uptrend, we say that the previous low should not be broken. So if the market takes out this low, then it invalidates this pullback here. So if the market starts to retrace and take out this low here, so if the market takes out this low, then it means that we no longer have a valid break of structure at this point. So automatically that break of structure is invalidated. Now, I'm going to explain that. When this low is taken out, it means that market can be doing one thing. The market was coming to take out liquidity below this zone. And also, this can mean a change of character. Now, let's discuss this so that we can have a foundation of what we are going to discuss before we move to the market, to the real charts. So this one, if the market was taking out liquidity, then it means that the market will continue with the same trend and give us now a varied break of structure that is at the top. So you're going to find that the market now will give you a valid break of structure at this point. And this one will no longer be a break of structure. So we'll have our first break of structure. And now at this point, we are going to consider this as a single move in the market. Now, remember that we always look at the highest and the lowest point in the market between that move of 1, 2, 3. So at this point, we have 1, 2, 3. So this is our highest point and our lowest point. Then at this point, this low has been taken out, this low here. So automatically, if this break of structure was valid, then it becomes invalid the moment this low is taken out, because this can mean that the market was taking out liquidity below this level here. So you're going to see so many examples in the market whereby you find that this low here has been taken out and the market continues. So we are going to have the next break of structure at this point, and this will be our 1, 2, 3. So this will be our next highest point and our lowest point. That brings us to the third point here. You always consider the highest and the lowest point, and that's why we call them, we refer to as higher highs, higher lows, because the market is moving from higher high. At this point, we have a higher low at that point. At this point here, we have a higher high. And at this point, we have a higher low at that point. So that was the first case scenario, whereby you find that the market, when the market takes out this low, then gives continue with the same direction. That is, it invalidates this break of structure at this point and gives us a valid break of structure at that point. Now, there are certain cases whereby if the market breaks this low to the downside, then it can mean a change in market direction. Now that's where we refer to as a change of character. So for a valid change of character, we are also going to look at that. So it means that now when this low has been taken out, that was a change of character at that point. And this break of structure here this is now a confluence to indicate that we have initially now we are from downtrend, we are from uptrend, and now we have entered in another market direction, that is the downtrend market. So a change of character and a break of structure signify a change in market direction. Now, we have the considerations when marking valid break of structures. We also have considerations when marking a valid change of character. So, one, when marking valid change of characters, we want to see the market break that is either the previous low or the previous high with a body and not a wick. So if the market, you find the market just wicked and the body did not close below that, the line where you have put the change of character, then it means that the market was just sweeping liquidity and we can have a reversal in the market. Then the second thing, or the second rule that you need to know, that now we have changed the direction you need a valid BOS. Reason being, we can have a change of character, yes, but the market can continue moving on an up, like the market can continue with the same trend. Reason being, the market was just taking out liquidity, like the first scenario which I gave at this point. Now, the last consideration when marking the break of structures is you need to understand that we usually use the Fibonacci retracement tool. So this is how you use the Fibonacci retracement tool to know if the level is a valid break of structure. So we have our Fibonacci retracement tool, and this Fibonacci retracement tool has we have different levels here. So we have from 0 to 50 or 0 to 0.5 and above. This is the premium zone. Then below 50 to 1, we have the discounted zone. That's why when you go to the market, you always want to purchase something with a discount. So we have that discounted zone. Now, we have that one crucial level in the market that we always consider, the OTE zone. That is between 0.618 and 0.786. So this is the OTE zone, whereby we look for better entries in the market. Now, this one means something. We have, in the market, we usually have deep retracements and shallow retracements. This is a deep retracement, and this is out of a weak trend in the market. So this one signifies a weak trend. It signifies a weak trend in the market. Then we usually have the shadow retracement. So for the shadow retracement, these are the considerations. So any deep retracement is from 50% and below. That is on the discounted zone. While a shadow retracement is usually above the 50% level. But one thing, for a pullback for us to say that this is a pullback, then it must reach the 0.382 level at that point. So when the market taps on this, then we have a valid break of structure. That is now a retracement. Now, I know that most people never knew of this, that you also consider, for you to consider a valid break of structure, you usually check if the market had retraced up to the 0.382 level. So that is a valid break of structure. Any moment you find yourself marking a level that is in between 0 and 0.382 as a valid break of structure, you have high chances that the market will liquidate you. So the market will drop and continue moving upwards from that level, because this is not any break of structure that you mark at this level is not valid. So let's now go to the charts and we can have a look at this in the real charts. So on my chart, I have Euro USD on the 1 hour time frame, and we are going to start marking. So we are going to start from there. So just ignore anything else on that other end. Now, at this point here, we have a higher hour, lower high, at this point. So that is our lower high, and this point here is our lower low at that point. So one thing that you know, the market breaks structure to the downside. So we have a valid break of structure at that point. And one thing, when I'm marking the break of structures, I usually consider marking them on the 1 hour time frame. So we have a break of structure, and you can see that we have imbalance. You know that sellers are dominant in the market. Then at this point here, have a look at this. The market did not, these weeks here did not break this high here. So we have equal highs in the market. So this is still a valid break of structure because we have these as equal highs. So we are not, that does not invalidate. So the market, this one does not invalidate that this is a break of structure because it never broke above this high here. Then the market continues, and we have that break of structure again to the downside. Now we have this as our highest point. Again, from there, we have another valid break of structure at that point. And we have this as our highest point in the market. From there, at this point, so we have this as our highest point, and we have this as the lowest point. Now, at this point, we are going to, we have this week. We have this week here. Now, this week, it's just wicked below this level because this is not, if you look at this, from 1, 2, 3, we have our highest point, our lowest point, our highest point. But this one, you can see that if this high went above this, then we should have considered this week here to give us the break of structure. But now this one, even if this week, this candlestick just week below that, this level here, it is still closed inside at this, above this level. So it means that that might be a liquidity sweep just below this level and all that. So again, we have another, we have the highest point and the lowest point. So we have this as the highest point in the market, which we can see. So we are going to mark it because we have this. So if you look at whatever is happening in between here, you can see that these candlesticks at this point, all of them, they just closed above. So it means that we have like some sort of equal lows at this point. Yeah. Now, I want us to see, how do you take entries in the market at these levels here? Because you need to have a look at the market in that perspective. So one thing, you can use the Fibonacci retracement tool for you to find an entry in the market. For example, if you pull your Fibonacci retracement tool from here to here, you can see that we have the OTE zone, that is 0.786 and 0.618. And the market retraced back to the OTE zone. So you just pull your rectangle at that point, mark the zone. So you just mark the OTE zone. Now you can take out the Fibonacci retracement tool, and at the 50% level of this, you can set your trade. So around that point, with your stop loss just some few pips above, aiming at that low to be taken out. And you can see that with that, you can be able to get a risk to reward ratio of 1:2, around 4. Then another way, you can just look for a demand zone or a supply zone in the market. And when doing this, make sure that you have in your mind, you are looking at the market from different angles, from multiple time frames. So you can also use the Fibonacci retracement tool. From that point and set your sell order or sell limit, at that point, targeting the market to take out the next low at that point. So with this method, you can secure a good risk to reward ratio, or else you can enter at that point. So it on depends with your entry model. Again, you can also, when the market is making the break of structures, you can find better zones, that is demand zones, for you to enter into the market. Like we have this example here. We have this bullish candlestick. So you mark it. This is the candlestick that led to the selling pressure, which we can see at this point. So you mark it as your demand. So you can see that the market just inside just a little bit in the demand and continued moving downwards. The same to this here. You can use the Fibonacci retracement tool, mark from the beginning of the trend to the end of the trend. And you can see that the market also came to the OTE zone at that point. Then you can set your trade at that at 50% level of the OTE, and target the low to be taken out. The next thing, on this you can mark your supply zone. Oh, sorry, I marked a demand zone at this point instead of a supply zone. I'm really sorry. So this is your supply zone. So you can also mark, you can see that this candlestick gave you, resulted to the selling pressure in the market. So you can mark it as your supply zone. And you can see that from that point, your stop loss just some few pips above, then your aim be the next zone to be taken out at that point. So you can secure yourself a risk to reward ratio of 1:2. Yeah, so that is how you basically trade when you have the break of structures. And marking and understanding the break of structures will help you a lot in knowing where are we going. And you are going to secure yourself better entries in the market. Catch up in the next video.